Recently, the Hyperliquid Jelly incident has become a hot topic in the crypto space. Hyperliquid is known as one of the most innovative decentralized trading platforms, built on a unique dual-layer design, a POS chain at the base, and Hyper EVM on top, delivering high performance and flexibility for on-chain trading. But this incident exposed a hard truth. No matter how advanced the technology is, without proper risk management, the system can still suffer major losses in a short time. In the Jelly case, the risks of low-cap projects weren't properly evaluated or controlled, leaving the market-making pool dangerously overexposed, and a chain reaction followed almost immediately. Meanwhile, centralized exchange KOL groups jumped in quickly. They organized counter-narratives on social media, amplifying the debate and fueling even more tension. So, this wasn't just a fight between technology and risk control. It was also a real collision between decentralized ideals and centralized interests. Looking deeper, Hyperliquid's problem isn't outdated technology, it's the disconnect between technical innovation and risk management. The platform uses a permissionless listing mechanism, meaning almost any project can go live instantly. While this boosts openness, it severely weakens risk assessment. When small-cap tokens experience sharp price swings, the HLP market-making pool is forced to take on far greater risk than expected. But without mechanisms like dynamic position limits or market cap thresholds, that risk quickly concentrated and exploded. Compared to centralized exchanges like Binance or OKX, Hyperliquid lacks a multi-layered risk control framework to separate assets of different risk levels. And while the platform claims to be decentralized, the reality is more fragile. Its validation mechanism relies on just 4 core nodes, and the code remains closed source. That leaves real concerns about governance and transparency. What's even more critical is the future. If Hyperliquid aims to support cross-chain liquidity, its current risk model simply isn't built to handle the complexity of cross-chain asset verification. This could allow risks to spread and even amplify across chains. The Jelly incident makes one thing clear. For decentralized exchanges to truly compete with centralized platforms in both scale and complexity, they must find a new balance between verification architecture and risk management systems. In response to the vulnerabilities exposed by the Jelly incident, DeepSafe introduces an entirely new verification layer solution designed to fundamentally rebuild the risk management framework for decentralized exchanges. At the heart of this lies DeepSafe CRVA cryptographic random verification, agent to breakthrough approach to asset custody and risk control. Rather than relying on fixed or predictable validators, CRVA uses advanced cryptography to ensure assets are securely managed under a decentralized architecture. The first key innovation is randomized verification. Committee members are selected at random, and even the nodes themselves have no idea when they will be called to participate. Think of it like a bank vault where guards are switched daily, and the guards themselves don't know if they'll be on duty until the last moment. This makes targeted acts or bribery nearly impossible, dramatically increasing system security. The second mechanism is periodic rotation. Committees rotate regularly, with old key shares completely invalidated and new ones generated afresh. Even if attackers manage to compromise part of the network in one cycle, they cannot maintain control into the next. This time isolation design ensures long-term protection for cross-chain assets, closing off the kind of persistent infiltration risks seen in centralized or static validator models. At the governance level, DeepSafe shifts risk control from human decision-making to algorithmic execution. With Ring VRF for randomness, T for secure execution, and zero-knowledge proofs for transparency, every verification and risk assessment is performed on-chain, openly auditable, and tamper-proof. This enables DEXs to achieve real-time, trustless risk control without relying on centralized authorities. For cross-chain asset management, CRVA introduces a revolutionary safeguard. Each chain's assets are assessed and isolated independently, while a unified verification layer provides a system-wide risk signal. This ensures that issues on one chain cannot cascade across others. Whether users are trading Bitcoin, Ethereum, or Solana, CRVA provides unified, decentralized verification without centralized custody or traditional cross-chain bridges. Assets remain on their native chains, under the user's full control, while still enabling seamless cross-chain transactions. On the efficiency side, CRVA leverages multi-party computation, so committees can jointly generate signatures with minimal latency. Even if some nodes go offline, the system remains stable. A dynamic committee mechanism scales validator numbers, up during peak demand and down during quieter periods, balancing throughput and efficiency. For users, the experience is straightforward. Cross-chain trading feels as simple as a native swap, without the complexity of bridges or multiple wallets. Beyond risk control, DeepSafe creates ecosystem-wide synergies. Once multiple platforms integrate with the same verification layer, they can share infrastructure for cross-chain validation. This reduces development and maintenance costs, while giving users a consistent, seamless multi-chain experience. Liquidity can flow freely across DEXs, improving price discovery and energizing the broader market. In the end, DeepSafe unifies security, efficiency, and decentralization through CRVA technology. It empowers DEXs to maintain openness and liquidity, while achieving risk management capabilities on par with or even beyond centralized exchanges. More than just addressing the flaws exposed by the Jelly incident, it provides the scalable, replicable infrastructure needed to support the next stage of decentralized finance. DeepSafe's cross-chain custody and verification solution marks a true milestone in DeFi infrastructure, redefining how assets are managed, secured, and traded across chains. For users, DEXs, and institutions alike, it opens the door to a future of safe, efficient, and transparent decentralized finance. As decentralized exchanges continue to expand rapidly, competition with centralized platforms is becoming increasingly intense. The Hyperliquid incident serves as a reminder that while technological innovation is essential, innovation without robust risk controls often becomes an entry point for attacks and can be exploited by centralized exchanges through their cold networks and market influence. At its core, this competition is not just about technical superiority, but about the balance between incentive models, user experience, and trust systems. Centralized exchanges deliver unmatched convenience through efficient custody and powerful market operations, but users must accept the inherent trust risks. In contrast, decentralized exchanges emphasize self-custody and transparency, yet face challenges such as fragmented liquidity and the complexity of cross-chain management. Users are forced to weigh convenience against security, and this trade-off continues to shape the structure of the entire industry. In this context, DeepSafe's verification layer introduces a new balance point. Powered by CRVA, DEXs can maintain decentralization and security while strengthening cross-chain asset management and risk controls. This not only helps them close critical technology gaps, but also enhances the user experience, making decentralized finance not just an ideological choice, but a practical and reliable reality. Looking at the broader technological trajectory, decentralized finance is moving through three key stages of evolution. In the short term, DEXs will improve existing risk controls by integrating verification layers to reduce security incidents. In the medium term, a unified verification layer will become a standard feature of cross-chain trading and asset management, with major DEXs connecting to infrastructures like DeepSafe to achieve system-wide liquidity and controllable risk. In the long term, as decentralization technologies and user adoption mature, DEXs will progressively replace many functions of centralized exchanges, unlocking a true full-chain trading ecosystem with significantly improved capital efficiency and liquidity. Equally important is the revolution in user experience. The Hyperliquid incident highlighted that technical innovation alone cannot satisfy user needs. It must be paired with comprehensive risk management. With DeepSafe, users enjoy the freedom of decentralized trading alongside the convenience traditionally offered by centralized platforms. Cross-chain transactions, asset management, and risk monitoring can all be handled in a unified interface, lowering barriers to adoption and eliminating the need to compromise between security and usability. This shift will also reshape the industry landscape. Instead of operating in isolation, DEXs will converge on shared verification layers and standardized infrastructures for cross-chain asset management. This enables interoperability, shared liquidity, and higher capital efficiency, while laying the groundwork for a safer and more sustainable decentralized finance ecosystem. Ultimately, DeepSafe's verification layer is more than a technical tool. It is a driving force for the evolution of DeFi itself. It equips DEXs not only to meet today's risk management challenges, but also to prepare for a future of full-chain trading, cross-chain interoperability, seamless user experience, and ecosystem-wide collaboration. With this foundation, decentralized finance can finally move from concept to reality, becoming an integral part of a global, open, transparent, and permissionless financial system. DeepSafe is not just a solution to existing technical gaps. It points the way forward for the entire industry, a future of secure, efficient, interoperable, and user-friendly decentralized finance.